All right, I think we're good to start. We're good to start, I believe, right?
I'm good.
Okay, perfect. Good afternoon, everyone. My name is Harry Singh, and I'm the chair of programming for CFS Society Winnipeg. Thank you for coming out today for our event here, virtual webinar from the Canadian Mortgage Housing Corporation. Before we start, a couple of housekeeping items. Everyone will be on mute, and their video will be turned off by our administrator. And that's pretty much about it. The presentation is going to take about 30 to 40 minutes, and then we can follow up with a Q&A session with our speaker. Now, before we begin, let us acknowledge that we are gathered today virtually on Treaty 1 territory, the traditional land of Anishinaabe, Cree, OG Cree, Dakota, and Dene nations, and the homeland of the Red River Métis. We also acknowledge that the water we drink and use comes from the Shoal Lake 40 First Nation. Speaking about CFA Society Winnipeg, the society has served the Winnipeg investment community for over 70 years by promoting ethical and professional standards within the investment industry. The society is an active participant and innovator with CFA Societies Canada and one of CFA Institute's global networks of local societies. Today, we have a presentation coming from Canadian Mortgage Housing Corporation, and we have Aled Ab Iorwerth from the Canadian Mortgage Housing Corporation, the Deputy Chief Economist for the organization. Aled joined the CMHC in the year 2016, bringing his strong analytical and research capabilities to bear on complex housing issues that we see in Canada. He previously had a 15-year career at Finance Canada in various research and analysis roles that included secondments to Environment Canada and the Council of Canadian Academies. Aled holds a PhD in economics from Western University and master's degree in European and International Relations from the University of Amsterdam and economics from Carleton University. Aled also speaks two other languages other than English, which includes French and Welsh. From here on, Aled, I'll let you take on the presentation. The floor is all yours.
Okay, thank you very much. Like Harry said, this is a presentation that should take 30 or 40 minutes, but in my experience, this topic gives rise to a lot of questions. So um, there'll be a lot of time at the end to ask those questions, and we can delve into quite a lot of the topics that are being discussed. Uh, how do I? Oops. I'm not used to using Zoom, so what I'll do is I'll go through the whole macro situation first, and then go into quite a little bit more on the precise housing situation. The macro situation, I mean, a lot of the housing people get really stuck up on understanding housing and get quite a lot of the intricacies of housing. But obviously, when we're looking at housing, the macroeconomic situation is really quite important. And as you all know, this is a little bit difficult to even understand these days, let alone forecast. So I think before I delve into housing, it's a little bit important to um, understand or at least acknowledge this uncertainty over the macro situation because it is having quite an impact on housing. So in general, say I'm doing this again more for completeness that the GDP numbers for Canada are not strong. And they're very difficult to forecast. When we did our forecast for 2025, we were quite pessimistic and thinking that it was highly likely to go, that the Canadian economy was likely to go into recession because of uncertainty about the the macroeconomic situation and the trade conditions south of the border. The Canadian economy has proven to be a lot more resilient than we projected. Whether that continues is very difficult to see. It seems that the some of the tariffs have come in a little bit less than broadcast, shall we say. Whether that continues is really difficult to say. Um, it's just important to keep that in mind. This has a particular impact on housing because, like I said, it really affects the demand for housing and people entering rental markets, entering home ownership, they're quite important in driving the what's going to happen to prices. And this chart here shows that we've had unemployment rates going up quite a bit across the provinces. The other part I should have mentioned this at the beginning is that I'm really going to talk about housing here across Canada. Later on, I will go into a little bit more detail on the prairies, but my overall focus is on housing across Canada, close parenthesis. Like I said, the unemployment rate has been going up, and this has been particularly the case in Ontario um, and amongst the young. So this again makes us a little bit cautious about what's going on the demand for housing. The hope is that in a few years this will resolve itself, but it's creating some concern at the moment. So that's demand is quite uncertain, and then I'm obviously an economist. I always like talking about supply and demand. And the challenge we're having on the supply side is that construction costs have gone up a lot since the pandemic. I'm just putting here a chart on the construction price growth as a summary of the challenges that are occurring on the supply side. There's materials cost, copper, cement, concrete, all that stuff, wood products. All of these costs have gone up since the pandemic, and really, there's a lot of supply chain challenges at the moment in housing. I'm not going to go into it in detail, but this challenge is also reflected in some recent work we've done on productivity in the construction sector. Not too sure how to put it diplomatically, but productivity growth in residential construction has been very weak. There was a quite a lot of U.S. papers on this topic on productivity in construction, and I think the word awful is used. So this is not a Canadian phenomenon, but the almost even a global phenomenon of weak productivity growth and strong increases in construction prices on the supply side. Now, I would note that a lot of other countries are moving to address this challenge. We can perhaps go into that later in the questions. Um, Countries ranging from Singapore to France are doing some things. Countries in Scandinavia are again trying to improve productivity in housing construction. And I think this is an area where Canada needs to do a lot more work. So we are facing in the long term, and I'll return to this in a minute, strong demand for housing. We are not producing enough housing, but there are problems within the supply side of housing. On the construction side, and I will probably return to this in a minute, also on the policy side. So again, before going into some of the details on housing, I thought I should also discuss some of the aspects more on the credit side, because we're obviously paying a lot of attention to this. There's a lot of concerns about what is happening on the household debt side. Obviously, house prices have gone up a lot, rents have gone up a lot. But if you're getting into home ownership, you're taking on a lot of mortgage debt. And Canada is now the country with some of the highest rates of mortgage or household debt, I should say, in the world. From memory, it's a competition between Canada and Australia and perhaps New Zealand about who has the most indebted household sector. The amount of household debt in Canada is more than the size of the economy. Um, so again, this is household net debt, not including government and obviously the corporate sector. So there's a lot of concern about household debt. Maybe just to explain why a little bit, the concern here is not so much the capacity to service this debt today. It is more if things go wrong, what will happen to that service at that time. I'm not predicting that stuff will go wrong, but the concern is if stuff goes wrong. So if there's a global recession, jobs are lost, and it's when you have that spike in unemployment that housing credit gets into problems. People no longer have a salary, they can't pay the mortgage, the banks repossess the house. A lot of banks repossess the house and try and sell it. It creates a downward spiral in house prices, which is roughly what happened in 2008 in the US. So the concern is not so much household debt today and the economy of today, but it's household debt if there's something going wrong in the economy. Now, and there are a few of these warning signs around. Nothing to uh, be seriously concerned about, but some things to continue monitoring. We have data on what the banks are doing on home purchases and on refinancing, and approval rates for refinancing are trending down. It seems that the banks are getting a little bit more cautious. I should say that these data are for chartered banks and not for the non-federally regulated institutions. So there's a little bit of concern here about, perhaps expressed by the banks, about the level of household debt. Looking in detail at the level of debt, it seems that the a lot of the mortgage activity is now in the uninsured space. So, as this audience probably knows, if you put less than 20% down on your mortgage, you have to get insurance from one of the three major insurers in Canada, CMHC being one of them, and then the other two private competitors. So if you put less than 20% down, you have to get insurance on your mortgage. If you put more than 20% down, you don't have to get insurance. And it seems there's a lot of activity and a lot of um, renewing and so forth in that uninsured part of the market. Uh, we had been concerned a few years ago that many people had taken out mortgages in 2020, 21. The typical 5-year mortgage in Canada meant that they would all be coming up for renewal in 2026, 25. And obviously they would have taken out mortgages in 2020, 21 at very low interest rates, perhaps around 2%, but they would be renewing at around, say, 4 to 5%. So this was seen as a risk. Um, my view was that it was a manageable risk in the sense that people would be able to pay the mortgages at these higher interest rates, but it would mean that there would be less money circulating in the rest of the economy. So it would be a drag on the economy. So this was quite a concern a couple of years ago. Uh, it is still something we're actively monitoring, but it's one of the small benefits of the increased international uncertainty that interest rates are lower than what we were forecasting a few years ago. And so the renewal burden might be less than we predicted, mostly because interest rates have come down or were not as high as we were anticipating. But again, we're predicting well over 1 million mortgages being renewed in 2026, and this is Obviously, when this happened, and there's a degree of sticker shock when you see the new interest rates, that this may still cause some turbulence. People, on the other side, people may also think it's not quite that severe because the when you pay your mortgage, obviously you pay part of it is on the principal and part of it is on the interest, and the shock is on the interest part, which may not be as large as your principal part. So the actual increase in how much you pay every month may not be as large as people think, given the change in the mortgage rate. So, but again, there may be some continuing concerns in this area, which we will continue to monitor. As I said, there's a lot of uncertainty in the economy at the moment. So when we have this sort of uncertainty, when we have unemployment going up, we really try and monitor what's happening on the mortgage renewals very carefully. We are seeing delinquencies, defaults going up. But they're not going up dramatically. As you see on the right here, the MIEs, there are the mortgage entities. Other people may call them MICs, mortgage insurance corporations. MIEs is a little bit broader than just the MICs. So traditionally, these have had a higher delinquency rates, but there's nothing dramatically going out of line on these delinquencies. Well, before getting to that, I'm not sure I had a slide, but we also look at these data on a geographic basis. Um, and what we're seeing in that area is, yes, delinquencies are going up in Toronto and Vancouver, but they're not out of the norm of what we have seen historically, particularly pre-pandemic. So there are warning signals there. It's something we're monitoring, but we don't have any evidence at the moment of anything going seriously wrong. Um, Perhaps not for this call, but if there has been a lot of concern expressed in the Toronto market in particular, and I'll return to that a little bit later. And the other point, I mean, like I said earlier, there are these risks of that when the economy goes south, people will not be able to pay their mortgages, and that leads to some risk of a vicious circle. But it is also true that Canadians have a lot of equity built up in their housing, and that's what this chart demonstrates. It's going to take a lot of price declines before the equity that has been built up by households is eaten into. So I'm now going to what I have been talking about until now is a little bit more on the short term macro situation, the state of the economy and the state of the credit markets. Perhaps again, I'll summarize at this point that on the demand side, it looks that demand for housing, it looks like a fairly weak picture. This is driven off the macro economy. Um, and everybody on this call probably understands the uncertainties and risks that have increased recently. And I think it's particularly the case in housing that if risks go up, the optimal thing to do is to do nothing, delay making a decision until the uncertainty starts to resolve itself. And it's very obvious that households will do this in housing. Buying a house is obviously a massive investment decisions for households. And given the size of that investment, and the extent of the risk in the economy, obviously, it makes sense for households to not make that purchase decision and to delay, and hence you've seen the volume of sales decline. So it's really that macro part that is driving the economy at the housing system at the moment. Again, to summarize, uh, on the supply side, the construction industry. It seems to have been really challenged since the pandemic. Construction costs have gone up. Productivity has been quite weak. And obviously, in Canada, we're very concerned about productivity overall, but the fact that the construction industry is not really very productive is a concern. And that's why there's a lot of discussion in Ottawa at the moment about what can we do to improve productivity in construction. Um, and then finally, there's the credit side. So there's warning signs. Stuff are not going in the right direction, but there's no obvious sign of major challenges. It's an area we keep on monitoring. If the economy continues in its current trundling along fairly quiet and calm, um, I'm not. It's unlikely to be that the credit situation will get out of control. Things seem fairly stable, but it's an area we're monitoring very closely. As I've said, the standard indicator is unemployment, and if you see a spike in unemployment, that's when you should need to start getting a little bit worried about the mortgage defaults and delinquencies. So that's a little bit of a discussion on the housing system in the short term. I'm now going to pivot a little bit to talk about some of the work that I've been advancing, and it's really trying to get to the crux of the affordability challenge that's affecting Canadians across the country, and why we need to build a lot more housing. And so I'll go into this for the remainder of the talk. And so, as we discuss what's going on the supply side, I'll also have to delve into perhaps which is a fairly hot topic in Toronto these days, about what is going on with condominiums and how this is creating short-term challenges. But getting back to my theme, it may create longer-term challenges in the opposite direction. And so what we see here in the chart are prices for condominiums over recent years. You see everything going up generally until what's that, 2022 during the pandemic, and then what happens in condominiums, they start to come down. And this seems to be a very specific Toronto issue. That there's some evidence of it in Vancouver as well, but it's really being driven by what's been going on in Toronto. They basically had a spurt of construction in Toronto. A lot of condominiums were built. A lot of people got into the pre-sale business during the pandemic. Interest rates came down. People thought, oh, housing is always going to go up. And so there was a bit of a pile-in into building new condos. And so there's been a lot of movement by small investors to build these condos. Um, I'm always in favor of more housing supply, but this has created its own dynamic and risk in Toronto, and has led to price declines in condominiums in Toronto. Um, Now, the issue with condominiums, to go a little bit into the history, is that what has generally happened is that since almost 1980, a very limited number of purpose-built rentals were built in Toronto. It's a little, the picture is different across the country, but there was a limited increase in supply in purpose-built rental over the last 4 decades. Um, when I when I say purpose-built rentals, I mean these apartment structures, 20, 30, 40 stories that are built with the intention of being rented out. There was a whole set of issues that came to the fore in the late 1970s, higher interest rates, rent control, changes in capital gains tax, and all of these came, you know, basically led to a collapse in rental structures being built around 1980. And be because of that decline in supply, If you wanted to rent a place in Toronto, you were really going to the condo sector to get something to rent. So individual investors would rent out their units, would put the money down on building condos, and would then rent out those units to make money. And it was relatively successful model for a while in getting new supply built. But that structure has now become under question, partly because of this sort of spurt in supply. Um, what has generally happened, and this looks at the individual investors, is that the cash flow from renting out those condos has not been going up, arguably going down. This links back to a comment I made earlier about spikes in unemployment in Toronto, particularly amongst the young who are likely to be renters. And so this has created a downward pressure on rent growth for those condominiums in Toronto. And so rent growth has not been great. And at the same time, you have um, construction costs going up. And so these guys have gone into negative cash flow. If you were thinking about buying a condo in 2020, probably you would have not cared about the negative cash flow because you were expecting a capital gain on the apartment you bought. But then going back to the previous slide, and you've seen condo prices in Toronto going down, that has led to people now being in a negative cash flow position and no expectation of short-term capital gains. Uh, the negatives, but that's so some people will stop there and say, okay, well, this is a problem. The condo situation is a problem, but obviously we need to take a longer term look at this and see um, what what the longer term consequences are. So on the left hand side, to repeat, is there's a lot of supply of new condos coming on the market, and this will take a while to absorb. But then on the right hand side there, you start to see what's going on housing starts. New projects being launched, new structures, people doing the selling for new structures. And obviously, the construction sector, the development sector, has seen what's happened on condos and said, okay, there's no way we're putting shovels in the ground. And so the launch of new projects has declined significantly. And so this is what happens. The bar on on the left there are are actual housing completions, and then they're sort of going up. Now, when we start to look at what's going on expected completions, because we know the start date, we know how long it typically takes to build stuff. And so on the right there, we're seeing, excuse me, on the right there, we're seeing what is expected to happen on the supply side. So, as I said, a completion is a start date plus expected time of construction. And so, the negative side of all of this condo trouble in Toronto at the moment is that the new supply is, I'm expecting it to fall quite dramatically. And a lot of the developers in Toronto are saying they are not putting shovels in the ground. And then that leads to knock-on concerns about, okay, if we're not hiring all of these tradespeople, then maybe they'll go off and do something else. And so that leads to its own set of issues. So my view on this at the moment is that any fall in condo prices in Toronto is likely to self-correct because um, we're, we're not likely to see a lot of supply coming on stream this year and next. The other side of what's been happening and which complicates the picture, as I said previously, there was a long-term decline in rental construction starting in 1980. Um, what has then happened is that the federal government in particular has become quite concerned about affordability issues, and starting around roughly 2015, 2016, started to put a lot more money to work on promoting construction of rental structures. And so you've seen a lot of new construction of rental buildings. This is through CMHC programs, MLI Select, the Apartment Construction Loan Program, and so forth. And so there has been a new upswing in rental construction. Now, the risk here is that these produce additional downward pressure in Toronto because you have the condos that were being rented out, plus you have this new supply of rental that is being promoted, and this might also put downward pressure. My view is a little bit more nuanced in this, in that although rental construction has gone up in Toronto, it is nowhere near enough what is needed. And so I think this will, as we go forward in time, will sort of, I still don't think there's enough rental construction in Toronto. If you adjust for the size of the Toronto economy and the number of people in Toronto, there's not that much rental construction going on in Toronto, particularly if you compare it to other places like Edmonton or Montreal. So that's the short-term supply issue, and now we move to the long-term challenge on affordability. Um, if I'd have been talking to you, say 10 years ago, I would have been complaining about affordability in Toronto and Vancouver. These days, now that I'm talking to you, there's affordability challenges in Toronto, Vancouver, Ottawa, Montreal, Halifax, and so forth. It's a little bit less in the prairies. Not so. There are housing challenges, of course, in Winnipeg and in Saskatchewan and Edmonton, Calgary, but they're nowhere as severe as what you see in a lot of the rest of the country. There are significant affordability challenges at Halifax. There seem to be challenges in Moncton. I get calls from journalists in St. John's, Newfoundland, saying, well, people are opposing new construction, and this is creating affordability challenges in Newfoundland. So it's a pervasive problem. Clearly, there are housing challenges like homelessness in Edmonton or whatever. Uh, but overall, I think the prairies are doing better compared to the challenges in like I said, Toronto, Vancouver, Ottawa, Montreal, Halifax. And so what we've been trying to do is to persuade people that if you want a long-term solution to this housing affordability problem, then you need to build more housing. There's a lot of ifs and buts, and but if you take the long-term perspective, this is the way to get back to affordability. And we're trying to really concentrate on this approach of increasing housing supply. So we've done this work, and our goal in this work was to try and figure out how much housing was needed in order to get back to pre-pandemic levels of affordability. So the red line there shows the pattern of affordability for Canada as a whole. And here I should be clear that when I talk about affordability, I mean home ownership affordability. It's the other way of putting it is this is affordability for middle class Canadians. There's an affordability challenge for low income and vulnerable Canadians, but what I'm talking about here is the challenge facing middle class Canadians. And you can see there the line on the right, the loss of affordability that has happened during and subsequent to the pandemic. And what we're trying to look at is how much housing supply we need in order to get back to pre-pandemic levels of affordability by increasing housing supply. And this is the result that we're getting. If we're looking at the largest six cities, we need a lot of housing supply to get back to 2019 levels of affordability. A lot of that is in Quebec, Montreal, and in Toronto and Ottawa. There is a subtlety here that lands me in trouble sometimes, and that is that when we get back to pre-pandemic levels of affordability, 2019 levels of affordability, That does mean that Toronto and Vancouver have still got an affordability problem. So we looked there at Vancouver requiring 7,000 additional housing starts in a year. Yeah, okay, so that gets them back to 2019 levels of affordability, but Vancouver was not affordable in 2019. And so if they really want to crack the problem of affordability in Vancouver, then you just need to drastically increase housing supply. The numbers here also get back a little bit to what I was saying about the different picture across the country. Edmonton, we're saying, is on track to build as much housing as is required to get affordability back to pre-pandemic levels by 2035. I find that the um, Edmonton housing system seems to work well. They produce a lot of housing. They seem to have a fairly rapid process of approving new housing. It just there's a little bit of a concern that Edmonton, rather than building up, they build horizontally. Maybe that's something for Edmonton, Alberta to figure out. But at least when it comes to affordability, Edmonton is succeeding. Um, yeah, I wasn't sure if I will go back and spend a little bit more time on this map. Because there are some parts here that I don't really show. So this shows the largest six urban areas in Canada. What is not shown are, for example, Halifax, which has had a significant loss of affordability since 2019, and so they need to drastically increase their housing supply. And again, all of this speaks to the need to get back to affordability, the need to increase housing supply, and so the analysis underlying this work says if you want to get back to housing affordability by 2019, you need to roughly double housing starts across the country over the next 10 years. And that only gets you back to 2019 levels of affordability, and it does not get you back to affordability in Vancouver and Toronto. Yeah. So I'll move on to conclusions, and I suspect you have a lot of questions. So I've discussed the macro risks, which everybody is probably familiar with. There's no obvious signs of credit problems. There's some warning signs, but nothing really seems to stand out. There are challenges within the condo market in Toronto. My suspicion is that that will self-correct because I'm anticipating that supply of condominiums or even total new supply in Toronto is A, not high enough anyhow, and B, will fall. So my suspicion is or my concern is that if the economy were to recover, if the global situation was to resolve itself, I have a little bit of a concern that we're going to have serious spikes in home prices, rents, and a general lack of affordability in a few years' time because they are not building enough housing in Toronto. And this will go back again to this boom and bust cycle. So you have the boom, not enough housing is being built, and so you have some speculative access on the way up. But then because of lags in the system, there will not be enough supply being built, and then as things go down, supply is taken off the market, and that leads to its own dynamic. So we need to somehow or other break out of the system of boom and bust on the supply side. So thank you very much. That's the presentation. I'm really open to questions of all sorts. Um, so I have views on the policy side. I think there have been a lot of moves in the right direction on the policy side, but I still think that there are serious challenges on the regulatory side. To put a little bit of color on that, people on this call may not be um, completely aware of the delays that are in the housing system, particularly if most of the people on the call are from the prairies. Our general sense, and there's the data on this is really iffy, but if you want to go through the regulatory system in, say, Edmonton, it probably takes about a year for you to get rezoning approval. If you want to do that in Toronto, Vancouver, it's a 3 year, 5 year, 7 year plus process. So the regulatory system is really different at the local level, and I think some serious reform is required in that area. So thank you very much, Harry. Open to questions and discussion.
Thanks, Aled. That was quite informative. To all the attendees, the chat box is open, and feel free to please pose your questions that you may have for Aled to answer. I do see that we have a couple of questions here, so Aled, I'll go through them one by one, and we'll kind of sort of go through as they come. And if
Yep.
people have anything else, we will be happy to answer them via email as well, but we'll get those details later on at the end. So the very first question we have is cost of building materials has been soaring since pandemic time, and so is housing prices. Does data suggest market is is in a bubble? Should the households expect property prices correction anytime soon? I'll repeat it if you
Um,
would like.
no, no, it's very dangerous to predict a bubble. As an economist, always a bit nervous of that. I don't get the sense that we're in a bubble, to be honest. I think there are structural problems in the housing system. I think, as you say, material costs have gone up. I think there are supply chain problems. I think productivity in the industry is a problem. I don't. We have other indicators to try and go into a little bit more depth on whether there is a bubble, and I don't see it at the moment. That's not to say that there are some parts that are a bit frothy, but if you look at some of the Alberta house prices, there's been fairly strong economic growth, relatively speaking, in Alberta, and so that supports some of the fundamentals. Can prices come down? Certainly, especially if the macro risk continues to increase. There's a lot of noise, as I said, in condos in Toronto. Prices could come down, um, but I don't know that I would associate it with a bubble. I have concerns that a bubble could emerge in a couple of years, especially as I said in Toronto, when you have supply going down at the moment. My concern is that in 2 or 3 years we could be in a bubble in Toronto because nothing is getting built and demand is going up. One thing I didn't really mention, and maybe there'll be a question on that, is there's still a lack of resolution on what's happening on the immigration side.
Okay, okay, that's fair enough. There was this question briefly that came up that got deleted. So I just still want to ask that question because I find it quite intriguing. Would you have any idea of what would be the supply chain factors that are causing to, um, sort of stopping the increase in production and meet with the demand? Do you see any of those? Are you aware of anything like that?
Yeah,
Anything impacting?
I don't have a very good answer of why productivity has declined over the last few years. But there's now been a few very high-tech papers that have looked into this issue around the world, and there's a bit of a standard answer that the residential construction industry doesn't really change its ways much. It seems that digitization, robotics, automation, it seems the whole digital revolution has bypassed the residential construction industry. I'm exaggerating a little bit. But building a house today and building a house 50 years ago, not that much difference. There's a bit of a joke circulating that the last major innovation in high-rise construction was the construction of the Empire State Building in 1929. So that it's but that's why there's quite a bit of activity in Ottawa now, Build Canada Homes, etc., and trying to see if more can be done on the prefab and this whole modular construction approach. I think there's something there, but then I look at Japan and they're really going in for robotics. And then there's other parts of the industry that are in other countries, I should say, that are going more into digitization, like what are called BIM technology, building information management systems. So um, I think there's a lot of conservatism in residential construction. There's perhaps not a major reason to innovate, given that house prices have been going up so much. But I think there is a need to change in the industry.
Okay, fair enough. We have some other questions as well. Do you have, or do you believe, or do you have any insights with regards to institutional investment in residential housing, particularly single-family residences? Is that affecting supply and pricing in the industry?
Um, Short answer is no, but there's a lot of stuff to unpack there. As a general truism, there is not a lot of single family rental in Canada compared to the US. A lot of rental in the US is single family, and there's been a lot of active investment by some of the large private equity firms in single family ownership since the pandemic. I think BlackRock has gone in, and this became an issue a week or two ago when the president said he was going to ban it. Now, what I just said is a general truism for Canada. There is more rental of single family homes, I believe, in Alberta, and it may be elsewhere in the prairies. But in places like Toronto and Vancouver, this does not really occur. If you're renting in Toronto, you're renting either from a condo or from a purpose-built rental, and not so much in single detached. Now, my view is that getting more private sector investment into rental construction and into well, yeah, rental construction overall would be a good thing. We have done extensive work that was released last year that shows that there are, well, let me put it in a more nuanced way. We do not find any evidence that there is any negative impact from having more private sector investment in rental construction. So we had very detailed data from Montreal, the REITs in Montreal, and there are higher rents charged by REITs in Montreal than by non-REITs. But that's because the REITs are spend more money on maintaining units, they buy units in better locations and so forth. So at the moment, we have no evidence of negative implications of large institutional investments in these large rental structures in Canada.
Okay, fair enough. There's another quick question about the prefab construction. Do you think that's increasing? Are you seeing that given that productivity has gone down? I know you briefly mentioned about having BIM system, building information management system, and the use of robotics. Um, Anything on that note? Prefab construction, precast concrete.
Yeah, there's a lot of people putting a lot of emphasis on a lot of weight on this, and I've talked to a few of the. You mentioned the prefab construction. There seems to be a lot of potential for this. There's a company in Southern Ontario. It seems they got really interesting technology. So I think there's a lot of potential in this. I think the industry will have to adjust to it and really take it up. Whether there is currently widespread adoption is difficult to say. I think there should be more. I think there's pressure on the industry to adapt. I gave a speech 3 or 4 years ago at the to the Quebec wood industry, and they were starting to take on board that they needed to adjust their processes because they were starting to lose market share to companies from Eastern Europe that were helping Quebec construction companies to get stuff built faster in Canada. So I think there is pressure to change. The extent of it at the moment is difficult to say, and so I'm a little bit concerned that there's a little bit too much hope, and not enough quantity. So um, but there must be something that could be done in this area.
Thanks for that, Aled. We have another question with regards to the negative equity in the houses, specifically in condos. So, given that the prices have come down in Toronto and Vancouver, particularly compared to when they were purchased in 2022, 2023, when the prices were higher, with the decline in prices and mortgage balances probably now exceeding home values. Do you have any data point on that, and what exactly are you observing or perhaps predicting, which is very difficult, but something on that note.
Yeah, I agree with the premise of the question, and that's why we're monitoring the system quite closely. Now our data is not quite as disaggregated as we would like. So we can, for example, look at what is happening in the uh, Toronto market for. We could look at data on what is happening in Toronto, but we can't single it out to people who bought in 2020 and bought a condo in 2020. So that our data is a little bit too aggregated, but we are trying to encourage other federal agencies to dig deeper into this. At the moment, we don't. Well, let me put it the other way around. There seems to be a lot of noise on social media in this area that this is a major disaster, and we don't see evidence of that at the moment, but it is something we are monitoring.
Okay, that's fair enough. I know you briefly touched during your presentation about the mortgage renewal. That's about 1 million mortgages being renewed this year, and it may not even have a big impact given the fact that the overnight rate and the repo rate has come down from the previous year's levels. Um, but do you think even going from 2%, back in the year 2020, 2021, when people logged in their 5-year mortgages for 2-ish%, I would say, give or take. And then now perhaps being in the vicinity of 4%, a little bit higher than that, which is again a 100% hike in the interest rate if you look at it from 2 to 4. Do you think that's going to impact the affordability, and that is going to create more pressure on the lenders, chartered banks, and other institutions? The
Um,
credit book, I would say, more the
yeah,
allowances
yeah.
and provisions, I would say, balance sheet and income statements, their items up.
My suspicion is no, because there have been other changes that have happened as well. So, and perhaps I should have mentioned these in the presentation. One is that, and I phrased the wording quite carefully in saying that people in Canada traditionally have had these 5-year mortgages, but people have been moving away from that. So we've now seen quite a few more people say doing 3-year or 4-year mortgages, and so there's a little bit of adjustment to try and again lower this interest rate. Um, so I'm a little bit, and people have also moved to variable rate mortgages. So there's been a move away from this fixed 5-year term, and that's a little bit passe at the moment. The other thing that's happened is that the amortization period has been extended. You can now go from up to 30-year amortization relative to 25. And again, we've seen a lot of movement by people into that 30-year amortization, which brings the interest payment down. Whether that's totally in their interest in the long term, I leave that to the accountants. But it seems that these adjustments are leading to less stress from this renewal wave. And I should also mention that because the all of these mortgages in 2020 were stress tested at a higher interest rate. What was it, the discount rate plus 2% or whatever? I don't remember. Um, Banks should have been prepared for this coming. So I don't. It's something we're monitoring, but I don't see huge risks at the moment.
Okay, that's fair enough. Now, I also know that you mentioned about total factor productivity in an economy. It plays a big factor, as to how efficient you become, how much cost you can save, and how much utility you can deliver for a particular product, which is its satisfying power. Now, this question is quite broad, and it particularly asks like, what is the major reason for increase in cost of building? What do you think?
Yeah, that's something we need to dig in more into because the other thing that I mentioned related more to construction cost of copper and cement and all that sort of stuff. What has also happened in parallel is that government fees have gone up, so development charges, development costs are really, I think, gone out of control. So if you're looking at Toronto, it's over 100K just in development fees. So these are the fees that the developer needs to pay to the municipality in order to cover hooking up to utilities and so forth, new schools and all of the costs that the municipal or all the services that the municipality provides when there is new housing. But these have been going up very, very strongly. So the costs I mentioned in my presentation were more about construction costs, but construction costs overall in this in new housing construction are all a bit out of control, I think.
Okay, fair enough. Now, this question is about pace of delivery. So, like, there's been a lot of money that's been allocated to national housing strategy, and the deployment of capital. It feels like it's slow compared to the urgency of crisis. Like, do you think CMHC is improving any of the internal processes to make to shorten the time span between funding announcement and shovels in the ground? Do you think that's happening to tackle with this problem?
Yeah, first of all, I'll make my excuse. I'm not really on commercial part, but I know from internal discussions that CMHC is always working to improve efficiencies and processes. So I think that's always in the work. I do think, however, that some of the from my perspective, some of the bigger problems occur more in the regulatory system, on getting rezoning, etc., not so much at the financing stage.
Okay, fair enough. It seems like we're almost on mark. We can take one more question perhaps. So we'll wait for a couple of minutes here or seconds just to see if anyone has any other questions. But if there's nothing coming to your mind right now for all the attendees, please send us your questions and we can forward them to Aled to see. Oh, I believe Andrew wants to ask something or someone else wants to ask. Oh, some of the attendees are coming online. But yeah, if you have any questions, please do send us at info@cfawinnipeg.ca and we will reach out to Aled with those questions to get some answers. But if no one has any questions, I'll keep the floor open for about the next 30 seconds to see if anyone has any questions. If you do not, send us an email. That would be great. We are also having an event on, I believe, February 18th or somewhere around there with BlackRock. The email was sent out a couple of days ago. We will be sending another email for the registration, and we would really appreciate if that event can also have a good level of attendees, just like what we have right here. So thank you so much. If no one has any other questions, I believe we just got one more, Aled. So is it okay if we can take one more question?
Yeah, yeah, go ahead.
Okay, so following up to the previous question with regards to the factors that are preventing the housing supply in Canada. Do you see interest rates and amortization extension and short-term variable renewals as sustainable adjustments, or more as a temporary bridge for homeowners right now? So I hope that question makes sense, or do you want me to rephrase that?
No, my general viewpoint to and maybe I'll re-emphasize some of the earlier question as well. My general viewpoint is that the major challenge um, in affordability in Canada is the regulatory process on rezoning, all of the development fees, all of that sort of stuff. Um, all of that is keeping construction costs, construction limited, shall we say. It's holding back construction. The um, the financing side, amortization, all that sort of stuff. It has some impact on the demand side, but I don't really see it as having in the long term when you control for the cycle and the rest of it, I don't know that this is having a significant effect on underlying real affordability. Um, the challenge, as far as I can see, is that construction costs, which reflect the regulatory and policy process, are just too high.
Yeah, perfect. I guess we are right on time. And as I've said, if you have any other questions, please send us at info@cfawinnipeg.ca and we'll be happy to take those to Aled. Aled, thank you so much for your time. We truly appreciate it as CFA Society Winnipeg. And thank you to all the attendees. This recording will be available on our YouTube channel over the next couple of days. But thank you so much for making this event a success and have yourself a great day ahead.
Thank you.
Thank you.
Bye now.